There's a question that almost every homeowner eventually asks, especially as they get closer to retirement. Should I pay off my mortgage or should I invest that money and earn a high return? And if you've ever asked a financial advisor that question, there's a good chance you've heard some version of this answer. Historically, the markets return more than your mortgage rate. You'll probably do better investing. Sounds logical. Sounds mathematical. Sounds responsible. But here's the problem. That answer usually ignores how people actually live, how stress works, and what money is really supposed to do. Because money isn't just about returns, it's about peace of mind. It's about flexibility. It's about control. So today, we're going to look at both sides of this decision, the financial reality and the emotional reality, and how to decide what actually matters for you. Not what a spreadsheet prefers, not what Wall Street prefers, but what makes your life better. Let's start with a statistic that rarely gets talked about. According to the Federal Reserve, nearly 40% of Americans aged 55 to 64 still carry a mortgage. And among retirees, housing is consistently listed as one of their top 3 financial stressors. And here's the kicker. Studies from behavioral finance show that people who enter retirement debt-free report significantly higher life satisfaction, even when they have less invested than peers who carry debt but have larger portfolios. In other words, some people technically have more money but feel less secure. That's the paradox we're unpacking today. Now, let's talk about the traditional advisor argument that the market will do better. The argument usually goes like this. 1, your mortgage interest rate might be somewhere between 3 to 6%. The long-term historical stock market average is somewhere around 8 to 10%. Therefore, investing instead of paying off the mortgage should produce more wealth over time. And on paper, that math can work out. Now let me give you an example. This is the spreadsheet winner. You have a mortgage balance of, let's say, $300,000, interest rate of 4%, an extra payment available $1,500 a month. If you invest that $1,500 a month, instead of paying down the mortgage, over 20 years at 8%, you might end up with over $800,000 versus paying off the house early and only saving interest. From a pure math standpoint, the market can win. But there are 3 huge assumptions baked into this logic. Assumption 1 is the returns are consistent. Markets don't move in straight lines. Yes, long-term averages look great, but no one lives in an average. People live in sequences. If you're investing during a lost decade, like we had from 2000 through 2010, maybe a prolonged bear market, or retiring into a downturn, those expected returns don't show up when you need them most. Meanwhile, your mortgage payment never takes a year off, never drops during a recession, and never adjusts for how the market feels. It's due every month, on time, no excuses. Assumption 2, you won't panic. This is the silent assumption that no one likes to talk about. It assumes you'll stay fully invested. You won't pull money out during downturns. You won't lose sleep watching balances drop. You won't change strategies midstream. But behavioral data shows that most investors underperform the market precisely because emotions get involved, like fear, anxiety, and second guessing. Paying off a mortgage doesn't require emotional discipline. It just works. Assumption 3 is debt doesn't affect how you feel. This is the biggest blind spot. Debt isn't just a number, it's a monthly obligation tied to job security, your health, market performance, and life uncertainty. You can't spreadsheet away the feeling of owing money. So that's why we have the emotional side of what debt really costs. Debt creates invisible pressure. Even low interest rate debt creates background stress, reduces your flexibility, and it creates a constant what-if factor. For example, what if I lose my job? What if markets fall? What if healthcare costs rise? A paid-off house changes the question from, can we afford this, to, do we want this? And that's a massive psychological shift. Now, the power of a paid-off home, when your mortgage is gone, your monthly expenses drop dramatically. Your required income drops, your financial plan becomes simpler, your risk tolerance naturally increases, And many people don't realize this, but paying off a mortgage is one of the only returns that is guaranteed, tax-free and volatility-free. There's no market crash that can undo it. So what really matters? Income, not net worth. People focus on their net worth, their account balances, hypothetical future values. But retirees don't live on net worth. They live on income. A paid-off house reduces required income, makes fixed income go further, lowers sequence of return risk, and then creates more margin for error. That margin is everything. Now, a different way to frame the decision is instead of asking what strategy earns more, try asking what strategy gives me more control. Control over monthly cash flow, stress, life choices, and retirement planning. The answer is surprisingly clear. This isn't an all or nothing conversation. Investing instead of paying off the mortgage can make sense if you already have strong guaranteed income. You're emotionally comfortable with the volatility. Your cash flow is secure. You don't plan to retire soon. And you value the liquidity over certainty. The key is intentionality, not default advice. Now, there is some middle ground most people miss. There's also a third option that rarely gets discussed. Partial mortgage payoff plus income-focused investing. This approach reduces your debt, lowers required income, keeps liquidity, improves your sleep at night, and it's not about maximizing the returns, it's about optimizing your life. Retirement changes the equation completely. Before retirement, income is coming in, time is on your side, volatility feels tolerable. After retirement, income must be produced, volatility feels personal, and debt feels heavier. The closer you are to retirement, the more valuable certainty becomes. The real risk no one talks about. The real risk isn't missing out on higher return. The risk is overestimating your tolerance, underestimating your stress, and building a plan that only works if everything goes right. A paid-off home gives you fewer failure points, fewer dependencies, more breathing room. That's not conservative. That's just smart. So what success actually looks like, at the end of the day, success isn't dying with the biggest account or winning a math competition or beating an index. Success is sleeping well, spending confidently, making choices without fear, knowing you're okay, even when things change. So the final thought here, the best decision is the one you can live with. There is no universal right answer, but there is a right answer for you. And it is the one that aligns with your finances, your emotions, your values, and your vision for the future. Money should support your life, not dominate it. If you're wrestling with this decision and you want clarity without pressure, here's your next step. Take time to look beyond the math. Look at your income needs. Look at your stress tolerance. Look at what makes you feel secure. And if you want help walking through that decision in any way that's clear, personalized, and focused on real life, not just projections, then start with a conversation. Not about products, not about performance, but about what kind of retirement actually feels good to live in. Because the best financial plan isn't the one that looks best on paper. It's the one that lets you live well, confidently, calmly, and on your own terms. I can adapt this into your financial plan. All you need to do is click the link below, and that way you can schedule some time with me and we'll help build this into your retirement plan if that's what you want. Otherwise, if you can, make sure to subscribe to the channel, and I'll see you in the next video.